All right, let's talk about AlTi Global's third quarter earnings call. On the surface, the numbers were, well, kind of confusing. You had this big revenue beat right next to an earnings miss. But if you dig a little deeper, management's telling a story about a massive strategic cleanup. So let's get into it and see if Wall Street is actually buying what they're selling. Here's how we're going to break it all down. We'll start with those confusing headlines. Then we'll dive into why this was such a messy quarter. After that, we'll look at management's game plan, see how the market reacted, and then we'll give you our rating and what we're looking for on the next call. You know, right out of the gate, AlTi's third quarter sent some seriously mixed signals. It was a classic case of good news, bad news, leaving investors scratching their heads and trying to figure out which narrative was the real one. And this, right here, gets to the heart of it. The conflict is crystal clear. On one side, you have the company bringing in way more cash than anyone expected. Fantastic. But on the other, they just couldn't turn that great top line into the bottom line profit that Wall Street was hoping for. So let's start with the good news, the top line. Revenue hit $57.2 million. That's a solid 10% jump from last year, and it blew past the consensus estimate by over $5 million. You can't argue with that. It's a clear win. But, and this is the big but, here's the other side of that coin. Adjusted earnings per share landed at just a penny. The street was looking for 3 cents. Now, a 2-cent miss might not sound like a lot, but it's exactly that kind of gap that makes the market start asking some tough questions. And to understand that EPS miss, you really have to roll up your sleeves and wade through a whole lot of noise. The official GAAP numbers showed this huge loss, but it turns out it was almost all driven by these big one-off charges that management says are just part of getting their house in order. The headline number was, wow, a GAAP net loss of $107 million. Per share, that's a loss of about 89 cents. So the big question is, how on earth do you get from that massive loss to a positive adjusted number? This is where it gets really interesting. If you break down that loss, the lion's share of it, we're talking about $100 million, came from just 3 things: a non-cash charge on their arbitrage fund, an adjustment for a tax asset, and costs from shutting down their international real estate arm. And believe me, management was hammering this point home on the call. The CFO basically said, look, almost all of these big adjustments were non-cash. In other words, this was a massive cleanup on paper and accounting exercise, not a situation where cash was flying out the door. It's all part of their new plan. So with all that messy cleanup stuff hopefully in the rearview mirror, management pivoted the conversation hard towards their new strategy. They're calling it Simplify to Scale, and it's basically their roadmap for where this company is headed. The big idea is actually pretty simple. They're drawing a line in the sand. They're getting out of that troublesome international real estate business so they can focus 100% of their energy on what they're really good at, managing money for ultra-high net worth clients all over the world. So how are they going to pull this off? Well, their plan really boils down to 3 main pillars. First, zero-based budgeting, which means every single dollar of spending has to be justified from scratch. Second, they're going to consolidate their tech platforms and their office space. The goal? It's ambitious. Find about $20 million in recurring savings every year by the end of 2026. Now, here's what's so crucial to remember. Underneath all this restructuring noise, the core business actually looks really healthy. I mean, they pulled in over $600 million in new international assets in just this quarter. Their partnership with Allianz is opening up private markets for clients. And maybe the most important number of all, client retention is a rock-solid 96%. People are sticking around. So you've got a messy quarter, a clear new strategy, and a solid core business. It's a pretty complicated story, right? So how did investors react to all of this? Well, let's just say they reacted with a healthy dose of skepticism. The numbers here don't lie. The day after the earnings call, AlTi's stock dropped almost 5%. And that was on a day when the broader market was actually up. That tells you a lot. This price action tells us the market is squarely in wait-and-see mode. Or maybe prove-it mode is more accurate. Investors heard the story about the turnaround, but they're not ready to pay for it just yet. They want to see the results first. And this really brings us to the central debate here. Is the market right to be cautious, worried that they might not be able to pull off this big change? Or is Wall Street getting too hung up on the messy accounting and totally missing the real progress happening in the core business? Okay, so let's wrap this all up and look ahead. Based on everything we just went through, here's our take on what to expect next quarter, plus our official rating on the stock. For the fourth quarter, we're expecting revenue to keep chugging along nicely, thanks to those strong asset inflows. We also think we'll see their profit margins get a little bit better as those first cost savings start to trickle through. But, and this is key, we think the stock price is probably going to be stuck in a holding pattern until the company can deliver a truly clean quarter without all these big, confusing adjustments. So when you put it all together, the potential of the turnaround balanced against the risk and the market's prove-it attitude, we're initiating our rating on AlTi Global with a market perform. So what does that actually mean? Well, for us, it means we expect the stock to perform pretty much in line with its peers over the next 6 to 12 months. The turnaround story is real, it has merit, but right now, we think the market is correctly pricing in the risk that comes with trying to execute such a big, complex restructuring.
And as always, just a quick reminder for everyone, this analysis is for informational purposes only. This is not financial advice.